Hello, everyone, and welcome to the latest webinar in our series titled Housing and Your Living Standard, Housing Decisions During Retirement, presented by our dear friend of the company, Rick Miller. I know we've had Rick on a couple of times before, but I just wanted to give a brief overview of who Rick is. Rick is the CEO of Sensible Financial, which is an excellent financial planning firm, as I do say so myself, and holds a Ph.D. in economics from the University of Chicago. So he knows what he's talking about. I just wanted to say a few introductory things before we begin. Rick's presentation is slated to go for about an hour today, and then we'll move to Q&A, and I'll relay questions to Rick. Please submit your questions in the question chat box located on your control panel. We're not going to be unmuting anyone today. Just submit your question in the questions box, and I'll relay it to him. We've got a lot of people on today, so we might not be able to get to everyone's questions. There's a lot of people on, but we'll do the best job we can. If for some reason we don't get to your question, you can always email questions to me at alex@economicsecurityplanning.com. And lastly, I want to assure everyone that this webinar is being recorded and will be available by next week at the latest, along with the PowerPoint slides. So with that, I'll turn it over to Rick.
Thanks, Alex. And it's good to be back. I will tell you just a little bit more about myself, as Alex was very kind to introduce me and give you a sense of who I am, but there's a little bit more about me. Before I started Sensible Financial, I also did some teaching and some management consulting, and I've been using MaxiFi for quite a long time, and I think it's very valuable software. So let's move on and talk about housing in retirement. And today, we're going to start with a bit of background on housing as an investment. We'll talk about the two primary alternatives for purchasing housing, buying and renting. And then we'll explore one of the most important questions about housing. How much can we afford to spend? Then we'll move on and look at a topic that's of much interest to a lot of clients in our practice, which is whether people should realize their dream of owning a vacation home. Is that desirable? Is it realistic? And finally, we'll think about downsizing or dreamsizing. Housing is a major part of your retirement lifestyle, and should it be part of your retirement dream? Before we get into it, I'd like to leave you, or I'd like to start with some takeaways that I hope you will extract from today's session. First of all, housing is a risky investment. We tend to think about it as fixed, so we don't think about it very often, and I'm going to suggest that you may benefit from thinking about it a little bit more regularly. Unlike many other fixed expenses, such as taxes or insurance, housing is central to your living standard, and that makes it a little bit different in the way we should think about it. The lifetime balance sheet offers us an essential perspective, as housing, if you think about it as a capital expense, is a stock. It's very lumpy. If you rent, it's a flow, and then you can compare it to other expenses. But generally, if you buy a house, you're putting out a very large amount of money, and it's hard to compare it to other expenses that you make on a daily or weekly or monthly basis. If you're an owner, many housing expenses are irregular, and we tend to underestimate those. And when you're thinking about the cost of housing, it's very important to attempt to include all of those irregular costs. And finally, if you buy a house, that, as I said, was a lumpy expenditure, but there are ways to access it flexibly without selling. And that's important to bear in mind, especially as we move into retirement. In this background section, we're going to talk about housing in retirement, which is qualitatively different than housing at other times in your life. And secondly, that housing may be a riskier investment than you think. When you are retiring, the housing decision is different than when you're starting out or accommodating a growing family. Your capabilities will change as you age. Your housing decision has to recognize that. It's better if you can plan for the changes that are coming, and those changes are both physical and to a certain extent those are somewhat obvious. We can see older people and we can see that they're perhaps not as strong as they used to be, perhaps not as flexible as they used to be, but there are also changes in emotional energy, and that's important to bear in mind as well. We encourage clients to make their housing choices with a focus on flexibility without requiring nimbleness. And what I mean by that is we're looking for single flexible solutions. Either, for example, one house that could accommodate your changing capabilities, or in some cases, something that's called a CCRC, or a continuing care retirement community. And that's not something we're going to discuss further today, but I mentioned that as an example of a housing choice that offers flexibility without requiring nimbleness. So we're going to begin the discussion of investments with a quiz or a poll. And we're going to ask how much homes appreciate each year, or how much you think homes appreciate each year. And Alex, I'm going to ask you to put the poll out, and we'll give everyone an opportunity to weigh in.
Okay, let's do this. Let's see. I think, does everyone see? I think everyone sees this poll, so we'll just give it, yeah, and people are responding to it. Let's give it about maybe 30 seconds to a minute here. See where people land up.
And I want to emphasize this is U.S. homes that we're talking about, how much they've appreciated in value over time. We're trying to get a sense of what the average price growth has been each year.
And Rick, do you see the results coming in on your end too? Should be on there.
Let's see if I can see that.
I
do. Yeah. I do see the results coming in, and I'm hopeful we're going to be able to display them.
Well, I think, yeah, I think we will be once I close the poll. But okay. 82% of people have voted. Let's see if that goes up just a little bit more.
Okay, I think that the votes are rolling in a little bit more slowly now.
Okay, so I think 85 is probably a good percentage to close the poll at. So let's close the poll and let's share the results. Okay, does everyone see this?
I do not, but I mean, I see that I will read out the results. I just see my screen. So I will read out, and I will see that say that the winner with 44% of the vote was 2.5%. Second was 1.5% with 35% of the vote. 14% voted for 0.5%. And then we had 7% at 7.5 and 1% at 9.5. And I will admit, and now Alex, we can take the poll down so that I can display the results, or the truth, if you will. Okay. And the answer is all of the above. It just depends on what time period you're talking about. Now, I will say that if you were thinking about the long time, then the people who voted for 0.5% are correct. You notice that and the data that we have goes back only to 1890, and we're indebted to Robert Shiller, who's an economist at Yale, a Nobel Prize winner, for this information. But from 1890 to 2021, the real annual appreciation in house prices was 0.5%. But if you voted for 1.5%, you would be right about 1987 to 2021. And if you voted for 2.5%, you'd be right about 1987 to 2006. Even the people who voted for 9.5% would be right if you're thinking about last year. which was a time period in which we had extraordinarily rapid house price appreciation. Now let's move and look a little bit more closely at this information. And this is Shiller's data over the last 130 years. And you see, first of all, I've marked in red the annual growth rate of 0.5%, and that would suggest that it's been slow and steady. But in reality, that's not what the data show. The data show that prices were approximately flat for the first 20 years, and then they declined. This is through World War I, and then stable basically through the Great Depression, rising during the period running up to World War II, and then World War II, then flat, and very flat through this period here up to 1970 or 75, and then decline, and then up and down and up and down and up and down, and then a recovery. So this is the great financial crisis, and this is the run up to the great financial crisis. And the point I'm trying to make is that housing prices have not been steady here, and price fluctuations are risk. If you had bought in 1990 and sold around in the late 90s, that would have been, you would have lost money. If you bought in the late 90s and then sold in 2006, you would have made money, and that's a lot of money. It's important to bear in mind that recent experience, while we tend to rely on it heavily, doesn't necessarily inform us about what will happen in the future. Let's look at this a little bit more closely now. Here are housing prices in Boston from 1988 to the present. And I have at the top a quote, or not a quote, but sort of a common sense or wisdom, which is as safe as houses, that houses are something that are very reliable, and that their prices are very reliable. And the data say something different. On a year-by-year basis, the prices have changed either positively or negatively by as much as 15%. And that is not stable, at least not to me. Prices didn't rise every year. They fell a lot some years. In Boston, the decline was not as large as the average national decline, but there is still a great deal of variability in house prices. These are averages across Boston. So you can imagine that if we looked at neighborhoods, if we looked at towns around Boston, that we might see even more volatility than we see in the average. And Boston was different from other cities. Here, if we look at 2006 to 2021, the average, remember, in this period of time was about 0. We see Boston here on average with about a 0.5% gain every year. Everybody knows that Las Vegas had a really hard time in the great financial crisis, but Phoenix, Chicago did worse than Detroit over this time period. So the bottom line is, you can't count on your house to be a great investment. Now, let's move on to the questions of the day, and let's start with buying versus renting. These are the Robinsons. They are going to be our client couple throughout today's discussion. They intend to leave their family home for a new, smaller home in retirement. They earn a comfortable living. They don't have to worry about their children. They can focus on their future. And they are savers. They're saving as much as they can into their 401ks. And the table doesn't show it, but they're also adding $2,000 or $3,000 a year to their savings. And they've accumulated very respectable retirement accounts. Joan has $1 million in her 401k. Mark has $800,000, and they have another $250,000 in their savings account. And they're getting very close to retirement. On the previous slide, it pointed out that they're 68 years old, and they're planning to retire at 70. And the first thing they're going to do is to think about whether they should buy or rent. And both buying and renting have financial advantages. On the owning side, renters pay just this year's rent every year, and there's something of a temptation to overspend. And I've written here, force saving, make one big decision. If you are buying a house, you're going to put a large amount of money into the house, either your money or if you borrow someone else's money, but you own the house and you own the full value of the house, and it sits on your balance sheet, and you've made a large purchase all at once, and you're not going to change how much you're spending on housing from year to year, whereas renters can do that. The second advantage is one that people tend not to think of, and it's much beloved by economists, and that is that an owner of a house is both the landlord and the tenant, and is providing housing services to the tenant, but the tenant doesn't pay rent through the market or doesn't pay rent in cash or in dollars, and so the landlord doesn't receive that rent as taxable income and therefore doesn't pay tax on it. Whereas the owner of a rental property is receiving the rent as taxable income, does pay tax on it, and therefore is at something of a disadvantage after tax to the landlord, the owner, the person that owns a house. The owner benefits from any appreciation that occurs, and the owner can't outlive their ownership of the house, if you will. They're always going to have a place to live as long as they can pay taxes and insurance. Now, renters have advantages as well. They pay lower transaction costs. When you buy a house, you pay the broker's commission, there are closing costs and so forth, or when you sell the house, the same. There are large transaction costs. Renters typically pay relatively low transaction costs. They don't have a concentrated investment. They can diversify their investment. If owners have a house in a specific geographical area, and it's all residential real estate, renters who could, let's say, have bought a house of a certain size can instead invest those assets in multiple geographies and in multiple asset classes. They can be much better diversified. They don't bear any loss if the house declines in value, and they don't have a large illiquid asset. So their financial position is more liquid. There are emotional advantages as well. On the owners have an asset that feels safe because they know it. And this, when I meet with clients, I grab the table and say that a house is tangible. You can touch it. If you own it, you have a feeling of stability. Whereas with financial assets, you don't have that same confidence, let's say, that you know the asset. And that confidence is irrational, because as we just saw, house prices can go up and down a lot. They can go up and down as much or more than stocks. So that confidence or comfort is misplaced. It is true that the house is theirs. They can do with it what they want. They can update it when they want. They have something to leave to their kids. They have shared family experiences that are available for life. Renters can have that too, but it's easier to see for owners. And on the other hand, renters have minimal transaction costs when they move. It's easy for them to move. If they are unhappy with their job, they can move to another city without any difficulty in terms of selling their house. Even if the price, let's say, of the property has fallen where they're living, doesn't concern them. They're concerned about where they're going to go and what the costs are there, rather than whether housing prices have risen or fallen where they are. And also, they're not responsible for upkeep. So if the roof starts to leak, if the landlord is responsible, it's the landlord's responsibility to pay for that. Owners are buying a lifetime of housing services, and I've written here a lifetime of imputed rent. And I've produced an illustrative chart here, starting in 2021 and going out for 100 years. And when you buy a house, you've bought the right to all of these housing services. And I'm showing that the value of those services declines for two reasons. First of all, houses depreciate. They require maintenance. And to keep this curve flatter requires investment, requires replacing the roof, requires updating the kitchen, requires updating bathrooms, keeping the house painted if it's painted, tuck pointing if it's brick, and so forth. Every homeowner has their own list of costs that have to be covered. The second reason that the curve declines is that housing services in the future are worth less today than housing services today. And interest rates right now are low at 0.5%, but still there is some impact of real interest rates on the present value of services, let's say in 2071. And this chart is designed to make my point about when you buy a house, you're buying a stock, so you're paying for all of these rental services or all of these housing services at once. When you rent, you're paying just for this year's housing services. And what makes the housing decision particularly difficult is this difficulty in comparison. It's incommensurate with every other decision that we make. Okay. All right. So when we think about housing costs, it's very helpful, I think, to enumerate them. When we buy, we're paying the broker, we're paying settlement costs. Ongoing, we have real estate taxes, homeowners insurance. These are the costs that we tend to think about. There's major maintenance, which is depreciation, which is a cost that we tend not to incorporate. And so if we step back for a second, the buyer has just bought an asset with fluctuating value, that's investment risk, and no planning software that I've seen, including MaxiFi, accounts for this. And it's very difficult to do. The data are not readily available. But nevertheless, it's important to bear that in mind. The buyer is also buying a damageable asset, so there's casualty risk, depreciating asset, so there's maintenance. And all of those costs are important costs, and we ignore them at our peril. The renter, on the other hand, receives housing services, and with their rental payment is compensating the owner for all of the costs that I just enumerated, that if the rent is well set. In addition, the renter is paying probably for utilities and is paying for renter's insurance, but that insurance covers only the contents of the property. Homeowner's insurance covers the structure and the contents. And generally speaking, the structure is much more valuable and the insurance is more expensive. Now, let's have the Robinsons, or see how the Robinsons are comparing buying and renting. They're thinking about a $750,000 house, and that house is in a town that charges $9,750 for taxes. They figured out that their insurance would be $1,500 a year. I am asserting that major maintenance should be recognized at $11,250 a year. We've done some research, and you can see it on our website, that suggests that 2% of the value of the dwelling, that's not the value of the property, but the value of the dwelling, that's the replacement cost of the house. That 2% of that is a good estimate of the average annual expenditure to maintain the property. Minor maintenance, which might be replacing, you can replace a lot of light bulbs for $3,750, but I'm thinking about the costs of keeping the driveway plowed and the lawn cut and other things of that sort. That fits in minor maintenance. And then $2,800 for utilities. There's an opportunity cost. If interest rates were higher, that opportunity cost would be much larger. And I've called it a net opportunity cost, and I'm subtracting the real interest rate from the anticipated appreciation rate. And when we add these figures, the real estate taxes down to the opportunity cost, we get the annual housing cost. And I've come up with about $28,700. And I've set the rent so that it will be the same. So what do the Robinsons find? If they use MaxiFi, they find the following. So we're looking here at the consumption spending that they can afford in 3 scenarios. One is if they just stay where they are, and their house now is $1 million house, and they could just stay there, and they're currently spending $65,000 a year on their living standard. If they just stay where they are, they could spend $74,000. If they move to the $750,000 house, then they have more capacity to spend on their day-to-day living standard. But if they rent, they can spend a terrific amount more. So renting is giving them a lot of capacity to travel, to gift to their children for unanticipated risks, to give to charity if they so choose. What else is going on here? The fundamental difference from MaxiFi's perspective is that in general, when we're using MaxiFi, we assume that owners of houses are going to keep them for life and leave them to their heirs. When we're considering renting, we're no longer doing that. We're going to sell the house and spend all of the proceeds on rent and on increasing their living standard. And at the end of their lives, if the Robinsons do this, and if they spend at the $111,000 a year that they could, there's nothing left for Jessica and Theodore to inherit. And also, if they spend at that level, their capacity to deal with unexpected expenses is much less. So maybe they don't want to do that. So suppose that they set money aside. Suppose they establish a reserve fund, and MaxiFi allows us to do that. And so we set it up as the reserve fund being set up in 2024 when they're selling their house. And we set it up for $734,000. We put it in a taxable account, and they can use that reserve fund for gifting, for unexpected emergencies, for a bequest. And if the Robinsons can keep their hands off of it, then it will work just as well as perhaps the home in terms of being a store of value. And one important difference is that this reserve fund could be invested in a very diversified manner, whereas the home that they're downsizing to is in one place and in one asset class. And having done that, we see that retiring and renting with a reserve fund is very similar to retiring and downsizing, almost identical. And so we're back to the advantages and disadvantages of owning versus renting that we talked about earlier. The investment risk and diversification, for the owner, the untaxed imputed rent, and for the renter, the advantage in terms of transaction costs and flexibility. And here's a sort of a more detailed summary. I won't spend a lot of time here because I think we're a little bit pressed for time. And I've said all of this, so I'm going to move on to the next slide. And one thing I did want to think about a little bit is what owners can do if they have an emergency, if they need cash, but their house is illiquid. What can they do? Well, they can borrow against the value of the home with a home equity line of credit. Retirees can use what's called a HECM or a reverse mortgage. And Larry, I know, has talked about this in one of these webinars, so I'm not going to talk about it today. Owners can do an installment sale to their children. And all of those approaches will allow the owner to take cash out of the house without selling it. On the other hand, if we're renting and we set up a reserve fund, we have cash and it's readily available. So there's more flexibility with the rent approach, but the owning approach is not entirely inflexible. When we think about renting versus buying then, the main points are, to do a fair comparison, you have to analyze all the ownership costs, and I would emphasize maintenance and depreciation. Again, remember that we have this stock flow problem, so looking at, let's say, the MaxiFi summary is going to be very helpful because it allows you to bring the capital expenditure in line with the annual rental expenditure. Renters, in order to preserve a bequest possibility, renters can set aside the prior home equity or some fraction of it. And finally, the investment as something of a wild card here, with homes being risky investments, and that risk, unfortunately, is very difficult to quantify. And this is the assumptions. I'm going to skip over this. We can come back if people have questions. And we'll move on to thinking about how much house we can afford. And the Robinsons have decided that they're going to buy rather than rent. And now they're asking how much they can afford to spend. And as they do that, I'm going to encourage them to think ahead. They may have 20, 30, or even 40 years to go. And they need to think about whether the house or houses that they're considering will serve them well over that period. And if not, how long they're likely to stay in the home they're going to buy now, what they would do if they needed to extract equity, and whether the house offers special amenities that will allow them to spend less on day-to-day living. And one of the most important questions is how many times they'll move. And there are many reasons why people might want to move. And I've categorized them here as social, comfort, and health. One of the things that, one of the factors that clients mention most often when they're talking about where they might plan to live in retirement is where their children will live. And that has a big influence on where clients end up living. Clients are also very interested, some of them, in having a warm place to go in the wintertime and a comfortable place to be in the summertime. People also may have to move to accommodate changing abilities. And as I've said before, major change becomes more difficult as people get older. And the Robinsons have decided that they don't want to downsize. They want more house. And there are lots of different reasons why a house might be more expensive, and I've listed some of them here. But I've said here that the Robinsons want to go for the gusto, and gusto has a special meaning for everyone, and I've listed a few. The Robinsons do not want to overspend, though. They want to be able to continue to maintain their current living standard. And therefore, they're considering more house. Remember, they have $1 million house now, but they're considering one that's a little bit more expensive at $1.1 million, or one that's a lot more expensive at $1,750,000. And I say, that's a lot of gusto. I've included a lot of expenses here to get to the annual housing cost. Again, so we're translating this capital cost, the house value, into an annual cost. And the annual cost is the one that is most easily comparable to other expenses that the Robinsons have. And let's see how it plays out. Well, they picked Morehouse very carefully, and it looks like they can just afford that and maintain their current living standard. But much Morehouse is just way out of reach. When you buy larger or when you spend more on housing, that reduces the resources that are available for consumption, and it can also influence your flexibility, as I've talked about before. And I wanted to emphasize that in retirement, the considerations that I've listed on this page are more important or more salient than they might have been earlier in your lives. So at this stage in life, once you're retired, your financial flexibility is less because you can't work more anymore. And that's, so you've got less financial flexibility, you may have less physical flexibility. If your liquid assets are reduced, that can be really a concern, because all our lives, we're used to seeing our liquid assets, our financial assets grow, we save. Once we retire, we start to think about, we should be thinking about drawing down those assets. And if they come down too quickly, that can be frightening. Especially if you're drawing if you've made aggressive retirement account distributions, if you have unusual expenses, you may need to accelerate your distributions from retirement accounts, and that can be a concern as well. And then at the end here, I've said the much more house that we looked at, the $1.75 million house, with spending at $22,000 day-to-day living, that's what I would call the epitome of house poor. And even the Morehouse approach reduces surplus nearly to zero. And here we see that. We're looking at the lifetime balance sheet for the $1.1 million house. And we have total assets, total lifetime assets, total lifetime spending, and we see that, remember that I said that the sustainable consumption was $66,000. The lifetime surplus is only $40,000. That's not a lot of margin. But the Robinsons aren't really very happy with this analysis. They still want more house, but $1.1 million isn't really much different than the $1 million house that they have now. And they're looking for some other way to approach this, some way that they could have more house, at least for a while. And their financial planner says, well, you could buy that much more house now, and then, or in 2024, and then you could downsize later. And so you'd have that really big house or that really wonderful house for a while, and then maybe when you're 80, which is how old they'll be in 2034, they won't really be able to appreciate that grand purchase that they're considering, and they could sell it and move to a less expensive house. And it turns out that that works. This seems to be the perfect solution. As long as they're willing to move after 10 years, then they can get 10 years in that really expensive house that they're considering, and still have substantial surplus. They could spend $75,000 a year instead of the $65,000 that they're spending now. And since they weren't sure they were going to get much benefit out of that really big house after 80 anyway, that works. And they'll still have $750,000 to leave to Jessica and Theo, because that's what the downsized house costs. So that approach, that plan B, will work. It seems like they can have their cake and eat it too. But there are non-financial risks here, and these are not so easy to see at 68. So, and I'm emphasizing them here. It can be a major effort to move at 80. I'm going to show you that the financial pressure to move at 80 is going to be significant. And finally, if that house drops in value, it could put the plan at risk, because the plan assumes that they're going to be able to sell that $1.75 million house for about that much when they are ready to downsize. And if that house has dropped in value by 25%, let's say, then it will make it more difficult for the rest of the plan to work. And here's what's happening to their financial assets in this Plan B, where they buy the really expensive house at 70. Notice that, and I have them, in order to do this, I have them taking a mortgage. So notice that here they're going to buy this house, right, at 70 or 71, and their financial assets grow. These are their taxable financial assets, and these are Jones retirement assets. These are Mark's, and then this is their home equity. So they sell their current home for $1 million. They buy the $1.75 million house, take a mortgage, and they begin to pay for it. And the ongoing costs are substantial. Notice that their assets are drawing down very quickly, both because they're paying off the mortgage, but also because the annual expenses are high. And this is kind of scary. And if you project it, they're out of money at 86. So that's really concerning. Now, if they can get it done, if they can get the sale done at 80 or 81, then their home equity is back down to the $750,000 level. Their financial assets come back up, and they have plenty left. But if they don't get the full sale price when they downsize, or if they can't get the sale done fast enough, then this can be a real, it can be a dicey time. Okay, so when we're thinking about how much house we can afford, buying a more expensive house has favorable and unfavorable aspects financially. The favorable aspects are primarily that there's more in the bequest, more in that sort of guaranteed bequest, if you will. But if you plan to downsize, that introduces a degree of difficulty into your plan, and it adds investment risk. Well, what about a vacation home? The Robinsons are thinking that maybe a vacation home instead of the really big house might be a good alternative. When you're thinking about a vacation home, there are a number of questions to think about. Why do we want one? For many people, a vacation home is, I've called it a kind of a romantic ideal. It's something that people think about for much of their lives. But it's something that they may not think about with a lot of specificity. And considering some practical questions like the ones I've shown here can help you make a really good decision, or a better decision. So when you think about a vacation home, you could say, well, what if we just took vacations to where we're thinking of buying? What about other vacations? How much do we want to spend on those? How much will we use our vacation home? And are we willing to rent it out? And all of these affect the economics of the vacation home. And let's think about how much we'll use it, and let's come back to that stream of housing services that we talked about when we were talking about buying versus renting. And instead of looking at a lifetime now, we're going to look at a year. And we've looked at, or the Robinsons looked at, rental prices for a house that they're interested in the area where they are, and rental prices vary over the year. In January, February, and December, they're very high, and in the summer, they're higher, but in what we could call the shoulder seasons, they're less. And the annual cost then, the imputed rent for a house that they would buy would also follow this pattern. And it's worthwhile to think about how much of that stream you would take advantage of. Now, the Robinsons, or I'm going to suggest that the Robinsons are planning to use their house primarily, and I'm going to go back from the Robinsons because I'm going to say something different about the Robinsons in just a minute. I apologize. You might say, if you're thinking about this, well, I'm going to rent or use the property January, June, and December. And for the rest of the year, I'm not. Now, you're paying for those services whether or not you use them. And so if you don't rent it out during these periods, then the house is just going to sit there, and you're incurring the cost without getting any of the benefit. And therefore, thinking about how much you're going to use the home and whether you'll rent it out has a big impact on the economics. So the Robinsons say, yeah, we thought about that really big house and buying it and then selling it at 80, and it was too much trouble. So they've said, well, let's go to the smaller home, and let's have a vacation house. And you can see that they're skiers, and they're thinking about a $350,000 condo, but they're not going to rent it out. And they decide that they're going to compare it with taking special vacations. And they figure $13,500 a year until they're 90 would be a good choice. And I've encouraged them to make that choice because that's equal to the condo's annual operating expenses. And the special expenses are much cheaper. If they downsize and take special vacations, they've got $16,000 a year of margin. But if they buy the vacation home, then they've got very little in margin here, very little in surplus. And $13,500 will buy a lot of lift tickets. But just as with the buy versus rent decision, there's more going on financially than at first appears. Because the Robinsons haven't planned to sell their vacation home, Jessica and Theo would inherit it. But if they don't buy the vacation home, then again, they could spend all of that surplus, and then Jessica and Theo wouldn't get any of that as a part of their inheritance. So suppose instead that they plan to sell a vacation home in 2043. And now, if they sell when they're 90, the surplus is back. So that downsize and special vacations and downsize and then downsize, buy a vacation home and then sell a vacation home turn out to be about the same. And so we're back to now the question of, I think, whether they would really use the vacation home as much as they think, or whether they would benefit from having the flexibility of that $13,500 vacation budget, because they might not want to ski as much as they think. Even if they take this approach, because the total expenditure is smaller than in that case of the $1,750,000 home, there's much less pressure to sell here, because even if they can't sell, they still have money left over at the end of their lives. So this, and with a vacation home, in general, it's easier to sell than a primary home, because the vacation home is likely to be in a resort area. If it's a condo, it's likely to be one of many similar condos with really well-established prices. So if the Robinsons sell, they know what they're going to get. They're likely to be real estate agents who are very knowledgeable about selling a property like this. And it's unlikely that the Robinsons' vacation home will be full of stuff that will be hard for them to sort through. So we're much less concerned about a vacation home as as being difficult to change than we are about a primary home. Now, there's another benefit to downsizing and buying a vacation home as opposed to spending more on one house. So the $350,000 vacation home plus the $750,000 downsized home adds up to $1.1 million. And remember that the more house scenario also had a property that was worth $1.1 million. So in both cases, with more house and with downsize and vacation home, the total value of the homes is $1.1 million. But there will be, I think, less investment risk than there for the downsize and vacation home than there would be for buying one single home, because the properties are in different markets. And even if one market goes down, the other one may not. And to get a quantitative answer here, I've assumed a correlation between the downsize home and vacation home in terms of the price. But even if we don't know what the correlation is, as long as it's not 100%, as long as they're not next door to each other, it's likely that you're going to get some benefit, diversification benefit, from having a smaller home plus a vacation home as opposed to one large home. If you're thinking about a vacation home, there are some good reasons to think strongly about it, or to consider it as an option. And here are the best reasons that we see in our practice. And it adds up to, we'll use it, so that makes the transaction cost worthwhile. We can afford it, both financially and more emotionally, and we could give it up if we had to. If you can say all of those three things, then a vacation home is a reasonable thing, or a reasonable approach to consider. And now to the last question: should we downsize or dream size? And we could rephrase that as, should we reduce spending on housing to be able to spend more on other things? Or should we increase spending on housing and be willing to spend less on other things? And we're choosing here between two very different retirement lives. And it requires a lot of thought to figure out the answer for you to this question. In general, when we do planning, we set housing expenses as fixed, and we consider them to be unrelated to day-to-day living expenses. But that's really not right. It's clear that different housing choices will have an impact on other expenses. They'll have an impact on travel expenses. If you live close to your children, your travel expenses will be less than if you live far away. There can be large differences in cost of living. It's much more expensive to live in a major city or in Honolulu than it is in a smaller metropolitan area or even a rural area. And if you live close to attractions, you may have less vacation expenses because the things that you like to do are very close, and you don't have to travel to get to them. And I'm going to come back and reemphasize that whenever we're doing this comparison about housing costs and living standard, it's difficult because we're comparing a capital expenditure to an annual or monthly expense. And so we have to do the best we can to bring them into the same metric. And usually the way that I like to do that is to bring the housing expense, the capital expense, and turn it into an annual expense. And MaxiFi is great for that because it allows you to see the change in living standard that's implied by or required by purchasing a house of one expense or another. So that's an advantage that MaxiFi offers. Okay, so now the Robinsons are thinking about retirement in more detail, and they're considering two broad alternatives. One of them is traveling the world from a small, comfortable home, and that's the first one. And the second is buying a house on the water, on the ocean in this case, and using it intensively. And we've set this up so that there are substantial differences in cost here. So in the dream size case, we're looking at a house that's $1.1 million, and remember we saw that was affordable before, just barely, and we have the annual housing cost of $42,000 a year, or downsizing $750,000 for the price of the downsized house, with a lower annual cost, but now very significant vacation expenses from 2025 to 2043. So $38,500 a year will buy you a lot of wonderful vacations. So the annual housing costs are different, very different, but the vacation expenses are extraordinary. And I've carefully chosen these amounts so that comes out just about the same. Here's retire and downsize, and here's retire and downsize with those extra vacations, and here's retire and dream size. And these two, which are the alternatives that the Robinsons are considering, come out to be about the same. And the Robinsons would have about the same living standard. Let's look underneath the surface. Both choices, and I'm starting with the fact that they look as though, both of them, as though there's not much margin for error. But both choices may have more margin than you think. On the downsize and vacation side, they don't have to take the vacations that they're planning every year. If let's say their investments do poorly, they could say, well, we're just not going to go this year. They could let the property depreciate. That would reduce their annual maintenance expenses. That would reduce the inheritance that they can leave, but it financially it's flexible. And finally, they could take a reverse mortgage, which again might reduce the inheritance for Jessica and Theo, but would still allow the Robinsons to have extra cash if they needed it. On the dream size side, I think there are a number of things to think about. First of all, if they're on the ocean and they may not need 2 cars anymore. That would offer them a little flexibility. The current consumption number, that $65,000 that they're spending, includes $10,000 a year in vacations already. Maybe that's something that they don't have to do if they're living the dream on the ocean. And they like to eat out, but if they're living on the ocean, maybe they don't have to do that. Maybe they have a deck that looks out over the ocean and they'd rather eat in. So there's likely to be flexibility in their day-to-day living expenses. They could downsize later in life, and as we saw, that's a possibility. It would be easier at $1.1 million than at $1.75 million. There'd be less pressure, less financial pressure. So that would be less of a concern. But still, the issue of the energy required to make the move is present. And if they dream size, because they bought, they could do the same as if they downsize. They could let the property depreciate. They could take a reverse mortgage. As you think about your retirement living and living standard, it's important to think about other expenses and how those expenses might differ between the broad alternatives that you're considering. And those expenses could be different from one alternative to another. In the scenarios that we looked at, the non-consumption expenses were going to be different. And if we look at the at this list here, if we were considering living in the city, let's say, as opposed to living by the ocean, the auxiliary expenses are going to be different as well. If you live in the city, you're going to have restaurants and plays and music and opera, etc. But if you're living on the ocean, and let's say that that's the resort location. I've said if it's a real resort location, and here think Honolulu or your favorite dream vacation, everything is more expensive if you choose to live in a place like that. So, what will the Robinsons decide? What will you decide? Moving into retirement, and I'm going to read this slide because I think these points are all important. Moving into retirement implies change in many dimensions: how you use your time, how your relationships with family and friends operate, where you get your meaning from, where you get your money from. And these are all big changes. And if you add to these changes a change in where you live, they multiply. So it's a very big decision. It requires careful thought. And when I say careful thought, I mean, as a financial advisor, I think it requires analysis, careful analysis. And I say here that it rewards experimentation. So before you make the big move, try it out. Before you buy the house on the ocean, see if you can rent a house near the ocean and see if you really like it as much as you think you will. If you think you want to take big vacations and you're going to buy a smaller house and do that, take a big vacation. See if you enjoy it as much as you think you would. Making this housing decision, especially if you buy, is because the transaction cost is large, it's a big decision, and making it carefully is worth the time. And that is what I have to say. Thank you. Alex, we can take questions now.